In a bold move that caught Wall Street's attention, Warner Brothers Discovery (WBD) announced plans to separate its streaming and studios division from its legacy cable network business, triggering a near 7.3% jump in its share price before retracing by market close. While the pre-market euphoria gave way to more measured enthusiasm, the underlying message was clear. Markets believe this split could unlock trapped value. For investment analysts, this is not just another corporate reshuffle. It's a textbook case in how strategic separation, if well executed, can resolve a conglomerate discount and create conditions ripe for re-rating. This video explores the mechanics and valuation implications of WBD's planned split, from sum of the parts modeling and debt realignment to the capital market signaling embedded in such a strategic restructuring. The concept of a conglomerate discount is central to understanding why investors often cheer when diversified businesses choose to split. At its core, the discount reflects investor skepticism about management's ability to optimize across disparate segments. Different growth trajectories, capital intensity levels, and competitive dynamics make it hard for a one-size-fits-all strategy to succeed. In WBD's case, the streaming and studios arm, featuring crown jewels like HBO, Warner Brothers Pictures, and DC Studios, is a content-driven, forward-looking growth business. In contrast, the global network segment, anchored by CNN and Discovery, operates in a structurally declining space where cord-cutting and ad pressures erode long-term economics. Bundling these two businesses together likely diluted the growth engine's valuation, with investors applying a blended multiple too conservative for streaming and too generous for cable. Breaking them apart allows each to be assessed and valued on its own merits. From a valuation perspective, this is where things get interesting. A successful spin-off often functions like a financial unbundling of a firm's DNA. For analysts, this means dusting off the sum of the parts model. Let's hypothesize a base case. Assume the streaming and studios unit can trade at 8 times forward EBITDA, a discount to Netflix's double-digit multiple, but justified given WBD's debt and competitive landscape. Meanwhile, the networks arm, weighed down by secular decline, might only merit a 4 to 5x multiple. Currently, WBD trades at roughly 6x blended forward EBITDA. If the market begins to price each unit independently with re-rated multiples, the implied equity uplift can be substantial, even before accounting for debt restructuring or monetization of intercompany stakes. Another critical benefit is strategic clarity. Streaming and studios are now mandated to grow, whether through HBO Max investment, franchise expansion, or content licensing. They're no longer burdened by the need to subsidize cash flows for a declining cable business. Likewise, network executives can focus on optimizing cash generation, managing decline gracefully, and exploring strategic options, including partnerships or PE-backed consolidation. Crucially, capital allocation becomes more rational. The studios arm can prioritize content and subscriber acquisition, even if it means lower near-term margins. Meanwhile, the cable unit can prioritize debt reduction, dividend strategies, or efficiency gains. Investors no longer need to compromise on which playbook they're buying into. Any strategic separation is only as clean as its balance sheet allows. WBD's announcement included news of a $17.5 billion bridge loan from JPMorgan Chase, aimed at smoothing the financial transition. The goal? Deleveraging the streaming arm to ensure it doesn't inherit a bloated capital structure that depresses its valuation multiple. Moreover, the networks business will retain a 20% stake in the streaming entity, a stake it plans to monetize to help pay down debt. This signals to analysts that the company is thinking about capital structure in a dynamic, value-creating way, not just shifting paper around. If executed properly, this debt restructuring could provide leverage on equity value, not just financial leverage, but operational breathing room that supports a higher market-implied valuation. While shares surged over 10% in pre-market trading before closing down 3%, the volatility should not be misread. Markets often front-run spin announcements, particularly when speculation has already circulated, as was the case via the FT in 2023. The real question for analysts is not the one-day pop. It's whether the fundamentals support a re-rating. Execution, transparency on segment margins, and investor communication will all matter more than ticker movement. To analyze the split, investment analysts can adopt a three-step framework. Disaggregate segment financials, use disclosed EBITDA or adjusted EBIT figures for streaming and studios versus global networks. Adjust for central costs. Apply peer multiples, use Netflix, Paramount Plus, or Disney for streaming comps, Fox Corp or Nexstar for legacy TV. Adjust for capital structure, incorporate announced debt allocations and the 20% intercompany stake, applying a control versus minority discount if needed. This SOTP model can provide a range of equity values and help analysts track upside potential over time. Not all that splits glitters. S&P already warned that the separation could pressure ratings, particularly for the networks business, which lacks growth catalysts. The loss of cross-subsidization could accelerate its decline. Execution risk looms large. Investors will scrutinize whether Zaslav and Wiedenfels can manage a dual leadership transition while orchestrating a complex capital markets transaction. Fragmentation may also reduce bargaining power with advertisers and distributors. Moreover, short-term trading behavior can create false signals. The monetization of the 20% stake could be misinterpreted as equity dilution, when in fact it may enable deleveraging. This deal is a masterclass in the importance of narrative and structure. A compelling story, We're Unlocking Value, only works when underpinned by credible financial moves. Analysts must connect the dots between strategic rationale, operating metrics, and capital structure. Spin-offs aren't just balance sheet reshuffles, they're expressions of strategic intent. Whether it's about surfacing hidden assets or enabling different investor profiles to self-select, breakups can be build-ups in disguise. Warner Bros. Discovery's split may well become one of the most studied corporate moves in media over the coming years. Its success will hinge not just on storytelling, but on the clarity and coherence of its execution, both operationally and financially. For investors and analysts alike, this isn't just a headline. It's a working example of how structure shapes value and how breaking a business apart can sometimes be the most constructive move of all.